Hey guys, it's Eric. I'm back. All right, so this is March 2nd, 2023. I'm Eric Garland. Okay, so we're going to talk about CDIO. Yesterday I traded that, and let's take a look at it. There's a lot to unpack here. I got a lot on my screen. I mean, guys, please don't hold it against me. Okay, I put a lot of stuff on my screen, and I'm not a professional day trader, so please don't be taking my advice. This is these are the chronicles of my studying. Okay, so bear with me or don't bear with me, but either way, I've seen some things. Okay, so looking at this chart, I got in a few places here. This place I got in, I should not have got in, right here. But I kind of came and sat down to the chart and I said, ooh, that's a good place to get in. All right, what are we on the, we're on the 5 minute. All right, let's switch this back to the 1 minute. Come back here. And I'll tell you my rationale, which is the purpose of me doing these videos. Like I said, it's for me, it's not for you. But my rationale getting in here, let's see, hang on, let me pause. Yeah, here we go. For some reason when I have it on the 1 minute time frame, it doesn't show me my purchases. But when I have it on the 5 minute time frame, it does. Yeah, go figure. All right, let me see. Change that to 2 days, 1 minute. See if it does it. Nope, still doesn't do it. So we'll just do this. We'll put an arrow where I got in at. Come on. And then we'll make that the out arrow down. Okay. And we'll come back out. So somewhere's around here. Okay. All right, so I got in here. That wasn't a good place to get in at. I think I was looking for a continued bounce off of this 25 moving average. And again, so what I'm typically looking at is the 15 off the 15 moving average. 15. 25 is the yellow. I don't know if you can see my cursor. Nope, not gonna see it like that. Okay. All right, so yep. Don't mind me. Okay, so what I'm looking at is I'm trying to develop a strategy. Based around the 15-25 moving average. As long as it's over the 200 moving average and the VWAP, I'm looking for a good place of entry. Typically looking for lower volume and a volume from low crossing over high. So the low volume would be around the fast moving average for the volume cross would be the 6 moving average of the volume moving over the 50 moving average over the volume. And as far as the cross of the actual moving average of the close, I'm looking for the 15 to cross over the 25. As long as everything is over the VWAP, the volume weighted average price, under this is the thing, under the 2+ of the standard deviation of VWAP and over the 200 exponential moving average of the close, then enter. So this is the 15 close exponential moving average of the close. This is the 25. This is VWAP. This is the 200 EMA exponential moving average of the close. All right, and here, this guy here, I really need to rename that, but that's the relationship of the 15 to the 25 moving average. So that's looking at when one is crossing the over. So if the 15 moving average is over the 25 moving average, then you're going to have this positive. You're going to have this green. If this line starts closing in, then you're saying that the 15 is closing in on the 25, right? So you see the same thing up here. Okay, so that's really just showing visually what's going on between these two moving averages. And once I get to the point where I'm consistently, seeing this and doing this and checking this off, then I won't need to have all these indicators. I'll just be able to look at the chart and see what's going on. But for now, I'm using it as a visual, as a check to make sure that I'm getting into the higher profitability trades. Okay, the higher probability, which leads to profitability. Yeah. All right. So let's see. Let's get this out of here. All right. So this is the exponential moving average of the close. All right. And so this is the exponential moving average of, and it is exponential moving average. Sometimes I think people tend to do these kind of indicators as just simple moving averages, but I did it as an exponential moving average as well. Just kind of keeps the line smoother, and it takes some of the noise out. All right. So this is the exponential moving average of volume. Okay. And so this is the difference between the 6, which would be your fast line, and we can call this line because it's what it's crossing, this would be the 50. All right, so if we go up here into the volume block, this is your slower, this is your faster volume. That's your 6 moving average. Excuse me. And then this is this line here that's kind of trailing here is your 50 moving average. Okay, so as these start converging, this converges. As the 6 crosses below the 50, this should be crossing below. Okay, so that's all we're looking at there. Again, this is just a visualization of what's going on between these, because let's face it, trading is just about exchanges. It's just, literally, the word trade is exchanges. So you're looking at the relationship. So everything that you do with the chart should be relationship based. And that's one of the things I've really been working on, trying to understand why and when big sharks, big movers, whales will start moving. Is, there's one thing, is like, do you get in when they start moving, or do you follow the chart so that you can see where there's a potential for them to move? Do you get in before they move? Do you get in with them moving? Because I tell you, sometimes they'll get in, and they'll get in so quick and so fast that you can't even get in time. And if you get in, and where you get in, if it's not really a strong enough move, then technically they've already made that move. You're getting in then at the top. And so that's the problem that I keep finding that I have, is that at that point you're trying to do a scalp, but you're trying to change a scalp into a 1 to 5 risk to reward scenario. Whereas you say, so for instance, if you're looking, I've got the arrow now. Okay. I think I know why it did that. All right, cool. All right, so if you're looking at getting in here where everything kind of is quiet and slow, but then you wait for the sharks with the high volume to come in and do this move, well, by the time you see all this volume accumulating, it may have already moved up this high. So time you enter here, it may go up a little bit more, and you say, you know what, that's not enough meat on the bones to enter. Plus, I'm probably considering my exit, my stop loss down here. So then this is, like a 1 to 0.25 risk to reward or something like that. So I'm not getting out here. But then it starts dipping down, and you say, okay, well, maybe it's just not going to go up that high. You're expecting for it to go on up here, but it retreats pretty quickly, and now you're below your entry. So now you say, okay, do I get out? Well, maybe, but I think that's the danger in waiting for the sharks to come in, is that at that point, a lot of times you're already so far up the move. The problem with getting in prematurely is this thing can keep, like say you want to get in, if you think that this is a good place to get in, so it will continue and go up. Well, now sharks decided to move it on down. So now, you know, if you were considering this to be your risk, you want that and more to be your reward. Okay, so you might wait until it gets here and still stay in the trade, and then it comes down here, but then it continues to go down, then you get out, right? So now you've exited because you got in prematurely before a whale made its move. So that's the trouble of getting in prematurely. However, that's what I'm working on, is to really try to use all of these relationships to understand where there's the higher probability that that sharks will likely make their move. And so, that being said, all right, I think if I put, what'd I do? Oh, on demand, okay. So I think if I put, let's get this out of here. I think if I put a dot right here, then it'll give me the arrow from here out. Yeah, so if I just put something up there, it'll give me, yeah, let me have this arrow. Very good. All right, so let's look at these scenarios here. And of course, this is a pretty solid move for the day, so you don't have a whole lot of ebb and flows, ups and downs, and that kind of thing. I mean, you have plenty, but I'm just saying that the overall kind of trend line isn't really broken. I mean, the larger trend line isn't really broken for the day. Of course, if you're looking at something like this, then it's broken. If you're looking at something like this, then it's broken. So there's plenty of places where, yeah, you can say that it breaks just to do pullbacks and that kind of thing, and that's fair. But it's overall pretty strong stock. So the checklist that I have are that, one, it's over the 200 exponential moving average of the close. Two, it's over the volume weighted average price. And then I'm just looking at the relationship between the 25 exponential moving average of close and the 15 exponential moving average of the close. And so really, what I've been looking at in the last couple weeks is that I want to see the 15 cross under the 25. Okay, so if we look back, I wonder, can I quickly get out of this whole, let's see, save a set, full thing, we call it full thing. Okay, so we're gonna do that, and then just to try to make it easier for you guys, save a set full thing, and then we're gonna do, we're gonna take all this off. Should have kept that one. Cancel. All right, come on. All right, so we're gonna get rid of this one, this one, this one. I need to have the volume on there. Otherwise, I could put the volume up here, but we're gonna leave it as this. Save a set. We're gonna put this as base thing. All right. Okay, so this just clears a lot of clutter. All right, so and still, what I have here is the -2 standard of deviation of the VWAP and the +2 standard deviation of the VWAP. So that's what those are. All right, so what we're looking at is that the chart stock moved up. And let me get that a little bigger there. Okay, so the chart moved up. And then I find that I don't really want to get in on the move ups. I mean, you can. That's just not my strength, because like I said, I tend to get in at the wrong place. Surely you've seen before that you don't really want to get in on some of the higher volumes. You at least want to wait for the pullback, and then you can get in on the pullback. Problem with that pullback is it might keep going down. So if you know that strategy, great. If you don't know that strategy, then you're like me. Okay. But this is a good place to get in at right here, though. And on a different time scale, that might look like a 3-bar play or something like that, where you have 1 bar move up, 1 bar just kind of go over, hang tight, and then the next bar move up. So you get in on that 2nd bar, and then you get out on that 3rd bar. Okay. All right, but so after the stock moves up, now you have the separation, you have the divergence from the 15 moving average over the 25 moving average, right? Okay, so you want to wait for a decent pullback. So I consider this to be a continuation. So you got a move, continuation, and then a move, okay? I consider this to be a reversal, or a significant rest. So, I mean, but surely you're going from one trend, which is uptrend, and then that's your trend line there, right? And so that trend is obviously broken. Okay, so when it comes down into this next area here, that is obviously a different trend. That's a downtrend. So that's why I'm calling this a reversal point, because this is the reversal. This point starts a new uptrend. And that's why I'm calling that a reversal. Some people call it a rest. Some people call it a pullback. The terminology, I don't want to say that it doesn't matter, but I think you do need to recognize mainly that there is a break of market structure here. There's a break of higher highs, higher highs, higher highs, higher highs, higher low, higher low. Okay, so now you have a lower low. I think that's what's important. All right, so let's get this out of here. Okay, so again, I'm looking at, as the stock moves up, if it moves up balanced, looks pretty good, looks, pretty solid there. It's not a lot of volatility going up there. Here, it's a nice strong move up, not a lot of volatility. Here, you don't have a super huge retracement. Okay, so that looks good. And even when this drops, with this high volume, even when it drops to here. It doesn't drop all the way down to here. Okay, so I'm considering this to be a fairly strong move. So now the thing is, how do we and where do we get in at? So we want to look to see, like I said, for my particular strategies, I'm looking to see when this 15 crosses typically under the 25 moving average. And here it just crossed close to it, which that just may be good enough, right? That may be substantial enough. And that's what we have to figure out. So that's what we'll be doing over the next couple weeks and whatnot, is figuring that out. All right, so let's go back to studies, and we're going to load study set. I got a lot of different ones here. What do we say? Base thing? Nope, it's not base thing. It's the new one. Full thing. Where's full thing? There it is. Okay, so now we come back to all this madness. And so we're looking like I said, one of the initial things I want to look to see is when that moving average is starting to cross. So even here, I think we're in this zone, and as it pulled back here, when we're looking down here, it did not cross, the 15 didn't cross over under the 25. It didn't cross over under the 25. It did a dip twice, so maybe that's significant. It dipped once, moved up, and then dipped down to that same relative area, okay? And then when it moved up, maybe past this area, maybe that's when we get in. Because technically, if we draw that line up there, technically that was a decent entry. So you could have made that an entry and then made this down here your stop loss. And maybe I'll use that as the new one. And then look potentially as this +2 standard deviation as the exit. But let's see how far that moved up. This particular area here. Let's see how far it moved up. Because that would be what we might want to consider as the strategy. Okay, so we're going to draw a line. I need some space here. All right, so we're going to draw a line from here where it crossed down to here. We're saying that, so that is, woo, good gracious, that's 9%. All right, so when technically we want to draw that line going up. Same, about 9%. All right, so from there up to here, and I'm saying that because now at this level, it kind of gets hit by that bar, that bar, that bar, that bar, that bar. It gives you plenty of opportunities to get out, right? So I don't ever try to make a strategy so that I have only one place to get out at, because usually there's so much or there's so little activity at that wick that even if you wanted to get out, particularly with a sizable position, you couldn't get out anyway because there's just not enough shares being offered there, or buyers willing to take there. Okay, so if we look at the percentage on that one was 16%. This one's 9%. So if you're risking 9 and you're getting 16, that's almost a 1 to 2. Okay, so we'll say like 1 to 1.8, which, you know, if you're taking solid trades and you're waiting and you're doing all this kind of stuff, then 1 to 1.8 isn't bad, right? 1 to 4 is much better. But I think if you pay attention to some of the other things that are going on, you can make that risk more narrow. This is another thing that I was looking at in my trading is the wick. So not only do we really want to see that cross there. Let's go back. I knew I was going to do that. Not only do we want to see this cross here of so one, volume dropped below the 50 moving average. So on a move up, and let's go back out here. One of the things that I've seen since I started trading, one of the things I've consistently seen is that on a move up, that you have solid volume up, not an exponential amount of volume up, because if you have too much volume going up, then you actually risk that there's absorption at the top, and you know all the buyers are being absorbed by a bunch of selling. So that's not the place to get in. But if you have nice balance volume going up with price, then you know there's a pretty good chance that that's a stronger balance move. And so from that, one thing I've always seen is that there's less volume in the pullback. There's less volume in the pullback. That's across the board. I see that. So that one is like a golden rule for me. That one's a golden rule that just doesn't change. Okay. So for instance, I was telling you about that 3-bar play. That was a golden thing. Okay. And you see the same thing here, right? So look at this. You got this nice move up, And then this move over, this rest, is all characterized by lower volume. Lower, 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 lower. All characterized by lower volume. And then what do you have? You have volume up with a continuation. Okay, so that across the board is something that I always see. And that is why I have implemented the use of the volume cross, because I want to see that even with the nice move up, that volume has come down. That volume has come down without significantly dropping the price. All right, and so from there, volume comes back into the picture again. Okay, and the way I figure it is that when somebody's moving moving a chart up, when a chart is being moved up, it goes up with volume and it goes up with transactions. Okay, so at some point, you don't want to just keep blindly buying, because you need to check to see if you can get it cheaper, right? I mean, if you need to buy 1,000 loaves of bread, you might go to one place and get it as cheap as you can and just buy them all. The problem with these financial markets is that it's hard to buy all at one place, all at one price, because inventory runs out. I guess it's the same way with buying those loaves of bread. If you go to one store, you can't buy all 1,000 loaves of bread. You got to buy it either at different times, or you got to go to different stores. Different stores are going to have different prices. So what do? You buy the 150 that they have there, and then instead of ordering the other 850 online from them, you just kind of wait. You just kind of wait and see if in the next day, it's at the end of the month, if at the next day they're going to drop the price a little bit. If they drop the price, you go ahead and get another 150 bags. If they drop the price again, you get another 150 bags. But the problem is that when they stop dropping the price, then you just got to go ahead and buy what you need. So that's my rationale for why the market kind of pauses, because they're checking to see if anybody's willing to sell it for a lower price. Because in order for the market to move up, buyers have to buy the supply. The supply is up here. The supply is the sellers. Okay, so you got so many sellers willing to sell, and these buyers want to buy it, but they want to buy it all, right? But they can't buy it all at one time, because if they do, the price just goes straight through the roof, and the object is to make money, right? So, you don't want to push the price way too high, way too quick, because if you do, you stand less chance to make money. That's why you don't buy property and stuff at the top of the market, because you have nowhere to go but down. Okay, so stock moves up, check to see if there is anybody willing to sell. Here they found a big seller, or they found people willing to short the stock, and that's great for the buyers, because they know that they have enough strength, they have enough demand. There's enough demand here to support whatever the sellers, or potentially what the sellers are willing to sell. Okay, and that's the other thing about the market. Nothing is written in stone. So just because it comes down, just because there's demand, doesn't mean that somebody's not. The CEO isn't going to come in and sell 80% of the company right now. That so you just don't know. That's why you use your stop loss, because if the CEO does that, doesn't matter how much demand is there, this stock is going to drop. And even though there's still demand, the whales need to see how low it'll go before they decide to buy again. And if they're already in position here, if they already have their holdings right here, then they may just need to buy a lot here, convince you to buy, and then once you start buying, they sell, and it keeps dropping. And then they may have a large volume of buys here, convincing you to buy, and then as you're buying, they're selling to you. And that's why it just keeps going down. So there's still demand, it's just not the time, right? And that's the crazy thing about the market is, even though you know that there's good news, you know that there's reason for the stock to go up, it doesn't. And you have to put your emotions aside and just exit the position, wait for the next opportunity. I'm a certified bag holder. I got my card, right? I mean, I hold bags too, but it's this is truly a there's a lot to this. Okay. All right, so I can't back up anymore. All right, let's erase this then. All right, so where are we at now? Okay, so that's why this volume cross to the low side to me is important. Okay, so not only do you have this volume cross to the low side, but like I said, I'm looking for some semblance of one moving average to close in on another moving average. That just means that the short-term activity is mellowing out, right? Because the short-term activity is the move up, right? But there needs to be a mellowing out. So this has to calm down. And we know that the short-term activity, when it meets the medium-term activity, that's it calming down. Okay, so that's why I'm doing 15 and 25. All right, or you could do, 25 and 200. People have different strategies, but I do think that there's something to say about the moving average and that kind of thing. All right, so the moving average and the volume cross are two of the main crosses I'm looking at. This one down here that I made, this EATR average, I just made that one the other day. So that one's pretty much just looking at volatility. I'm sure there's another indicator that could be used for that. It's just a simple indicator that is let's see. I think it's a relationship of, no, I gotta go here. It's the relationship of the range. So it's just a average trading range. Let's see. I want you to see the code. I mean, this one, there's nothing serious to it. It's the average trading range, the exponential average from a fast moving average to a slow moving average. So the fast moving average is the average trading range of 5 bars, and the slow average trading range is the exponential trading range of 15 bars. All right. TradeStation is doing its own thing. Oh, it's getting close to 9:30. Maybe that's me. Looks like I've got delayed data. All right. Let's see. So next on the list, like I said, when we talk about the average trading range, we want to see that we have a certain amount. All right, so you just gonna pull up. You just gonna pull up on me. TradeStation is like, I want to be in the show. No, sir, not right now. All right, so we're looking at volatility has increased, right? So this is the I think it was the 6 or whatever it was. It was the fast moving average crossing over the slow moving average. So you get this, boom. Look at that. So obviously there was a rest, and in that rest, the trading range was more narrow, right? And the trading range, not only was it more narrow, but it fell below the slower trading range. So what's happening in the short term is different from what's happened in the medium term. And what's happening in the short term is that the range is getting smaller compared to the medium term. Okay, so look, the range got smaller. That's signified by this by the line being below 0. The range got smaller, and it's below the longer term, the broader term, medium term. And then from there, what happened? Low to high. You got to move up. Not only did you get a move up in price, but you also got to move up in volatility. So this indicator down here it's not telling you price. It's not telling you that the stock moved up. It's just telling you that the bars, that the range got wider, that from low to high. And I don't know if actual trading range is telling you the low to high, or if it's telling you the open to close. So I may modify that. I may modify this myself so that I can get exactly what I'm looking for. All right, the difference between the current high and the current low. So it's the high to the low. And so I may even want to change that from the high to low to the open to the close, because the high to low definitely incorporates the entire range, which I guess that's, the definition. But I may want it to just show me the open to the close. So just the body of the candle. Because some of those times those wicks can be wicky. They can be wicky. All right. So like I said, this doesn't tell you price. This tells you range. But when a stock moves in a direction, you tend to get wider ranges. So whether or not it doesn't matter. I mean, if the trend is a downtrend and the main leg is the down leg, then you're going to have longer red bars. The red bars are going to be longer, and the green bars, the pullbacks, are going to be shorter. And then you're going to have long red bars again. That's just how it happens. So again, as this range opens up, you want to see which direction the stock is going, what the legs are. The legs are bullish legs. You match that up. Okay. What's that doing? That's a bullish leg. That's a bullish leg. Oh, we got activity. All right. So all these, where the range breaks out, all these are longer. They're to the bullish side. Okay. So that's important, because then you know that we're still in an uptrend. Okay. All right. So we talked about actual trading range. We've talked about that before. We've talked about the difference between the 15 and the 25 exponential moving average at the close, and we talked about the cross of the volume, the 6 to the 50. So that's pretty much it for this particular trading strategy that I've been working on. But yeah, just kind of comparing all these and seeing when we have confluence. We know that word, the confluence, the coalescence of multiple factors all at one time, right? So like in here, got this nice spot here. The volume was low, right? It crossed here, moving up, perfect. Okay, and here the cross, the 15 was very close to the 25 moving average, and then here we have lower volatility compared to the broader range. So all these signify, and not only that, but it's holding a level. All right. So enter here maybe, and then consider this range. I cannot draw a straight line. Jesus. All right. So consider this range here from the top to the bottom. Consider that range. as your get out range. Okay, so we might put a stop loss in here. Like I said, that doesn't mean that it's going to go there. That doesn't mean that if it goes there, it won't go back up, which is the problem with you and me, is that we think that we can just go ahead and hold the bag. And just because we know that we are right, that if it drops below this range and it drops here, that we should just hold it just in case it might go back up. Well, if it goes back up and you were doing all these things and this was invalidated, then it's probably doing something different anyway. Okay? So unless holding it here is a part of another strategy that you have that says, okay, well, it does 1, 2, 3, drops below the 200 moving average and then shoots back up. I mean, if that's the case, you probably should have waited to get in at the drop down here and enter below the 200 moving average. And B, then you become the sucker that the market yearns for, because you're giving the market your money. And like I said, I got a bag holding card, so I don't fault you for it. I'm just saying, come on, guys, gals, let's do better. All right, that's all I'm gonna do for today. I was gonna go to the internet and we was gonna look at some of the information about OCEA, which seems to be similar to CDIO. CDIO, we're just going to talk about what they had going on as far as it being a cardio diagnostic holding company. They announced some expansion. And I think they also got a new patent or something of that nature. So honestly, stock could continue going up, or it could go down, or it could just shut down today. You never know. You don't know any of these things. Let's see what it did on open. Okay. Yeah, dropped a little bit. But that was a swell move yesterday. So if you got anything from this, leave a comment. And if you leave a comment, I will do a much better job next time. How about that? All right. This is Eric. I'm with Success Over Stress. I'm out. Peace.